The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Welcome to episode 31 of Wealth Talk. My name's Christian Rodwell, the Membership Director, and I'm joined by the founder, Mr. Kevin Whelan. Hello, Kevin.
Good morning, Chris. Pleasure to be with you today.
Good to speak to you again today, Kevin. Now, Kevin, we continue this week with our look at Pillar 4, which is property portfolio, and we've covered off several strategies over the last few weeks, and it's been really, really interesting listening to our different guests, hasn't it?
Yeah, it's fascinating to see what people really find an enthusiasm and a focus on. And when you combine, decent resources, lots of energy and enthusiasm, a willingness to get stuck in and not just go round in circles, turning the wheel, they get outstanding results. And what you're seeing, I think, is people just get bigger, stronger, better as they keep turning those wheels, because that just moves them forward and keeps propelling them to higher and more rarefied air.
Mm-hmm. And no matter which strategy someone chooses within property, one thing that they'll all have in common is managing their tax.
Well, the tax is the overlay to every single asset. So whatever asset you decide to invest in, there's going to be a different tax treatment. But Chris, we talk about this right from the very foundation of what we do when we're teaching wealth and the principles of building wealth with people. Do you remember Tax Freedom Day, Chris?
I do indeed, yes. Quite a surprising statistic, right? In that for someone who's working, the amount of tax that they pay, actually they work up until a date in April. It's calculated each year.
The 8th of May in 2019.
Well, yeah, so getting even later then in that case. So that's how long someone would work before they start actually earning any of that income for themselves. So that's the amount of tax that they need to pay.
That's right. And, the interesting thing about tax as a principle is, while we all have an obligation to pay our tax, the tax system is really set up for us to be able to minimize our taxes. And if you can minimize those and feel comfortable with retaining as much profit, as much income as possible, then of course it's going to help you focus and build your wealth. And so we teach this through our principle known as debits, if you remember that, and our foundation students will know that, where the different ways you can save money, and each letter stands for something: debt, education, bills, insurance, tax, and support costs. So it's at the very principle of what we do. And when you're building your wealth, you always have to work out the difference between gross income and net income. And that difference is almost always simply, or at least one of the big ingredients, is tax. And that's why it was just a thrill to invite someone to talk to us today, Chris, and share some wisdom on the subject of property. And while property is the focus of today, I would say just in general principle, there are some things that I think I would share in advance of hearing from the very colourful character, Mr. Shaz Nawaz. So you had a good interview with him, didn't you?
Yes, very, very, very lively character, and certainly knows his topic, that's for sure. So Shaz Nawaz, trusted expert in tax and chartered accountant for AA accountants. And perhaps you can explain your relationship with Shaz, Kevin.
Well, Shaz is, when you're as well connected as I am, and I seek out the best of the best of the best, and you have to do that. You always see the names that come up time and time and time again, and Shaz does that. And I met him, I really liked him. He's a no-nonsense character, as I said, very lively, very colourful. He's definitely one of those people you just don't forget, and he knows his stuff inside and out. And when I had the opportunity to speak on stage with him, I could tell just how enthusiastic he was and how generous he was with his time as well, not just on stage, but also to other people. So I think he's a great character to share knowledge with. But, one of the principles, and I'm sure he'll dive into a little bit more depth when it comes to property, is, in every single way of building wealth, there's always exemptions, and there are always reliefs, and there are always ways that you can minimize your taxes. And that's whether it's income tax, capital gains tax, whether it's corporation tax, whether it's inheritance tax. These are all the taxes that we have to overlay on everything we do. So it's quite a critical thing to build knowledge, and not just to deal with people who historically may be counting the beans for you and then tell you the tax you're going to pay. What you need is something proactive to be involved with you to help you minimize all of those taxes. So focusing on, well, what's exempt, and we talked on a previous podcast, Chris, about using different types of property, exempt residential property, if you remember that. We talked about the sort of properties you could buy with your pension, which you can't buy straightforward residential property. And of course, SSAS is a huge tax saver as well. So again, there's an overlay with tax and with the vehicles you use, because some are not just tax-free, but you also get tax relief. So you're essentially paid to do those things. So a SSAS will be eligible for tax relief. We've also spoken in previous podcasts, I think, about, and I'll bring it up again, actually, when we talk about the business pillar, Chris, where you can get life cover and claim tax relief on that life cover. So in fact, you pay no national insurance and you pay no taxes. And actually, the government are paying your insurance for you, which is often needed when people are building the roof of their wealth plan, keeping their family safe while they're still building their wealth. So all of this is critical, and one that I'm going to just love to share with you, Chris, but I'll make a kind of teaser point now, which is whenever you have a business and you sell that business, then you get something called entrepreneur's relief, which means you only pay tax at 10%. So, there's just wonderful opportunities that will allow you to mitigate, pay less tax, make more profit, and build your wealth. So these are the reasons why tax is such a critical thing. And we don't want people to be tax experts, because you can buy in that expertise, and a good accountant will save you way, way, way more money than they could possibly charge you. So I would say a good accountant is an investment, not a cost. And that's how wealth builders should see that.
Well, I'll prepare anyone listening right now to get a notepad and a pen, because what Shaz shares is really, really valuable. So shall we head on over and take a listen to that right now then, Kevin?
Look forward to that.
Okay, so I'm with Shaz Nawaz. Welcome to Wealth Talk, Shaz.
Thank you for having me, Chris. It's a pleasure.
Yeah, no, great to speak to you today, Shaz. Now, Shaz, we'd really like to just find out a bit from you, really, as to some of the things that property investors should definitely be thinking about when it comes to their personal tax strategy.
Absolutely. And I was thinking about this conversation that you and I were going to have. And I thought I'd look at how many different tax changes we've had, which have directly impacted property investors over the last few years. And since 1st of April 2013, I've managed to find 37 tax changes that directly impact property investors. And those tax changes haven't been extra tax reliefs or benefits or allowances. These are tax changes which in effect have meant that property investors need to pay more tax. So just 2 or 3 very quick examples are changes in wear and tear relief, changes in mortgage interest, changes in stamp duty, and all of these have impacted lots of property investors in very different ways. So the way that the tax regime and the climate is, I'm sure there's many more changes to come, tax changes, which are going to impact and affect property investors. So the point I'm trying to make is property investors need to be one step ahead of the game, and they need to make sure that they are claiming all their reliefs, exemptions and allowances to ensure that they are tax efficient. So the first and most obvious one is that everybody has a personal allowance, which at the moment is $12,500. And quite often I see property investors don't always utilize all of their personal allowance. So that personal allowance means you don't pay any tax up to £12,500. So it's important people utilize that. Above and beyond that, if they are running a limited company, they get an additional £2,000 tax-free by way of dividend. So they should ensure, if they have a limited company and they're a shareholder, that they take out £2,000 per shareholder tax-free. Above and beyond that, if they have loaned money to their limited company, which I'm sure you've seen before is a common scenario, a property investor either buys a property or invests into a project, and they use their own money to fund the purchase or a particular project. If they do that, they should charge interest to the company. And quite often, I find they don't. But if they do, and they're a basic rate taxpayer, the first £1,000 of savings income that they get, and charging interest is also savings income, is going to be tax-free. And that comes under the banner of the personal savings allowance. So it's £1,000 if you're a basic rate taxpayer, and it's £500 if you're a higher rate taxpayer. So people should take advantage of that. Also, if you have a husband, wife, or a civil partner, and if you are a basic rate taxpayer and your husband, wife, or civil partner isn't using up their personal allowance, you can use something called a marriage allowance and use 10% of their unused personal allowance and claim tax relief on that too. That comes to around, I think, £247 or something like that. And you can go back 4 years. So if your partner or husband or wife is earning less than £12,500, you can use their personal allowance, so long as you are a basic rate taxpayer. Now, this is where it gets interesting. If somebody earns £12,500, i.e. they're using up their personal allowance, and they don't have any other income, and they've loaned quite a bit of money to their limited company, let's just say £100,000 for this particular example, Chris, if they charge interest on that £100,000, they get something called the starting rate savings allowance, which means the first £5,000 worth of income, okay, is tax-free. So let's run with that example. So let's say, Chris, you've got £12,500 that you get by way of salary or other income. You then charge interest on your loan that you've given to your company. The first £5,000 is going to be tax-free. So you would end up on £17,500, okay, without paying a single penny in tax. You can then charge a further £1,000 in terms of interest by using your personal savings allowance, which I've just covered, which takes you to £18,500. You then take the £2,000 tax-free dividend, which takes you to £20,500 without paying a single penny in tax. Now, I know I've kind of run through that pretty quickly, and lots of people sometimes can't always follow the numbers, but I hope that's kind of made some sense, Chris. If it hasn't, obviously, yes, feel free to ask me a question, because it's important that your listeners kind of appreciate and understand this point fully.
No, thank you so much for running through that with Shazan. 37 tax changes you mentioned there. So this, again, it shows the importance of working with an accountant that really understands property. I know you're a property investor yourself, Shazan. You know, what are some of the other advantages of making sure that obviously you're working with an accountant that does understand all of these different property laws and changes?
Well, the first thing is obviously is that if you work with a specialist, they'll have lots of knowledge, experience, and expertise of having worked with other people in your sector. So not only will they understand all the different tax rules that apply to your business, they'll also be able to understand how to make the tax rules apply. And by that, what I mean is a property investor isn't always thinking about all the different tax rates, reliefs, and exemptions that apply to their business. But if they talk to a specialist, specialists would say, well, if you're looking to buy a commercial building, for example, which we'll cover in a short while when I share with you one of my existing or current property projects, if you're buying a commercial building, make sure that you make a claim for capital allowances, as an example. So that kind of triggers a point where the client starts thinking about capital allowances. There could be other scenarios where there's stamp duty involved. So we cover that particular avenue in terms of, is the property uninhabitable? How much are you paying for the property? Is there a mortgage on it? And various other things that can help you reduce the amount of stamp duty one pays. So working with a specialist, they'll pick up on these things, they'll flag them up, and then the client and the specialist can fully consider all the different options and then make an informed choice. That's the first thing. The second thing is, if you're working with a specialist who also does what you're doing. So in this particular case, for example, if you're working with a property specialist who also invests in property, they're going to be able to share their own experiences of how they are doing things in their property business. So not only will they be able to understand your journey, your pain points, your frustrations, they'll also be able to look at the opportunities and the advantages of how you can do things differently. So you kind of get two bites at the cherry by working with the same person without having to pay anything extra.
Now, one of the big changes over the last few years, Shaz, has obviously been the introduction of the Section 24. Is there anything you can add to this as to how best to manage?
Yeah, absolutely. I think the first thing is, I think that particular change was extremely unfair because if you look at any other business, if a business owner, let's say somebody who's selling stationery, if they obtain a loan for their business, they can claim 100% of the cost. So why should it be any different just because somebody owns a property business? So I think that particular change is extremely unfair, in my opinion, both as an investor and as a tax specialist. But moving on from that, I think a lot of people, Chris, have kind of jumped on the bandwagon where they haven't fully understood and acknowledged all the pros and cons for why they should incorporate their property business. So quite often I come across people who own 3 or 4 properties who've ended up incorporating when there was no need for them to incorporate. So they've incurred all those additional fees and lost some of the tax benefits or advantages of having the properties in their own names just because they thought incorporating was the best thing to do, because every other person they were talking to was saying you should incorporate your property portfolio. So I'll cover some of the pros and cons of having a limited company and some of the things people should consider. Before I do that, what I would say is, if we have a property investor who has losses in their property business, they shouldn't be looking to incorporate. The first thing they should do is use up those losses, because if you incorporate your property portfolio, you can't carry over your losses. So if you have losses, make sure you use them first. So some of the benefits, Chris, of having a limited company or running your property business through a limited company is you get to claim 100% of the mortgage interest. So you get full tax relief on that. The second kind of benefit, or the reason for doing it, is if you can demonstrate that you have a business, then when you move your property portfolio from your name or from your name and somebody else's as a partnership, for example, into a limited company, you claim Section 162 incorporation relief. And what that means is you don't have to pay any capital gains tax, because, of course, a limited company is a separate legal entity. So if you transfer something to a limited company, or if that buys something from you, you have to pay capital gains on it if it's a capital asset. But if you can demonstrate you have a property business or a business, then you don't pay capital gains tax by claiming Section 162 incorporation relief. The other thing to add on top of that is if you are moving your property portfolio over to a limited company, you'll have to pay stamp duty land tax. However, there is legislation which says that if a partnership incorporates, then the limited company doesn't have to pay stamp duty land tax. So if somebody owns property in their own name, they may claim Section 162 incorporation relief, but they still have to pay stamp duty on moving the properties over. And quite interestingly, I went for a haircut yesterday, and somebody was sat there, and we got talking, and I obviously kind of shared with them that I am a property investor, and I also work with property investors. And his accountant had incorporated his property portfolio, and he told me he'd paid over £42,000 in stamp duty. This is yesterday. £42,000 in stamp duty. And as I asked a few more questions, as soon as it's established, he should not have paid that stamp duty. So there are people out there who are paying lots of money because they aren't working with specialists. So you could claim Section 162 incorporation relief, no capital gains tax, and obviously pay no stamp duty. I say obviously if you are a partnership. The other big benefit is when you move the property portfolio from your own name or from the name of a partnership into a limited company, you get an increase in the base cost. Let me run you through this very quickly. Let's say, Chris, you've bought 10 properties over the last 10 years, and the average price you've paid is £100,000 each. So you've physically paid £1 million for those 10 properties. And let's say those 10 properties today are worth £2 million. If you were to sell them all, you've obviously made £1 million gain. So £2 million today's market value, less than £1 million you've paid for them. So that leaves £1 million taxable gain. You'd pay capital gains tax on that. Okay? And if you're a high rate taxpayer, you're paying 28% capital gains tax on that. However, once you move those properties into a limited company, you have an increase in your base cost. So let's say you move them on the same day. Now your base cost is £2 million. So if you sell one of those properties, and the average price, let's say per property is 200,000. If you sell one of those properties in 6 months' time for 200,000 or 210,000, you're only going to pay, if you sell it for 210,000, you're only going to pay tax on the £10,000 additional gain, which is a massive tax saving. And I've kind of run through that pretty quickly because obviously I know that there's plenty more to share, but I hope your listeners will kind of be able to look further into that in terms of the base cost increase and see the advantage. Another advantage is that when you have a limited company, the company pays corporation tax, which at the moment is at 19% and coming down to 17% in April 2020, whereas personally you could end up paying 20%, 40%, and then even 45% depending on your personal income. And if you take a salary and then take dividends, you've already seen that you can get a £2,000 tax-free dividend. You've got your personal allowance, and if you're really smart about it, you can take £8,632 as a salary as opposed to £12,500, and then you won't have to pay any national insurance. Another big advantage, and this is one of the big reasons why lots of people incorporate, generally speaking, Chris, is that you have limited liability. So if the company was to go bust, any assets in the company obviously are at risk, but you personally are not liable. Whereas obviously if you own the properties in your own name, if something goes wrong and you can't pay the debts or the loans, then your personal assets, i.e. money in your personal bank account, and your personal property, i.e. your home, is at risk. So with a limited company, you've got that, you ring fence the company and your liability is ring fenced to the company. So those are some of the benefits or some of the reasons you should be looking to incorporate and some of the things you should be considering. Now let's move over to some of the costs which people should consider or bear in mind. Obviously, when you move over your property portfolio, you'll have legal fees to pay. So make sure you've factored those into the costs. You'll also have to pay valuation fees if you've got mortgages on your properties. And of course, if you haven't got mortgages, the first question is then why are you looking to incorporate? Because Section 24 doesn't affect you because you're not paying any interest. The question could be an increase in the base cost, but that takes us down a different route. So legal fees, valuation fees, you might have to pay a higher rate of interest because sometimes the mortgage rates in a limited company can work out to be higher than in a personal name. You'll also have to pay arrangement fees to the mortgagee. You might have to pay stamp duty if the properties are in your individual name as opposed to a partnership, and you lose your annual exemption. So if you, Chris, make a capital gain of less than £12,000 in this particular tax year, you won't have to pay any capital gains tax. Unfortunately, a company doesn't have that annual exemption as an allowance, so you lose that £12,000 benefit. So those are some of the things people should be considering. There's a few others, but these are the kind of main ones to get people started.
Yeah, that's very helpful. I know it's a question that still comes up very often, doesn't it, amongst people? So thanks for sharing that with us, Shaz. And I know you mentioned you have a couple of examples that you'd like to run through for our listeners as well.
Yeah, I've got one really interesting example of a live case study, which is my own case study. So I'm working on a few different property projects, and I thought I'd share one with you and your listeners, which will hopefully demonstrate the value of good, sound tax planning. And everything that I'm about to share right now isn't risky, it's not pacey, it's not tax avoidance, it's real, basic, simple tax planning that's exceptionally effective. So you'll have to forgive me once more, Chris, because I'm going to run through numbers. So I hope as I run through them, I'm making sense. So yeah, and if I lose you for any reason, then it means I'll probably lose some of your listeners.
I'll be the one to pull you back.
Feel free to stop me and say, Shaz, that doesn't make sense. Can you run through that again? So we bought a property for £500,000. We then paid to obtain planning on it, and then legal fees and the stamp duty. That cost us £65,000. The refurb on that is going to cost us £400,000. We're then going to pay interest on the £400,000 because that's coming from a third-party lender. That's about £52,500. So all those four numbers added together gives us £1,017,500. The GDV on this particular project is 1.32 million. So we're going to make gross profit of 302,500. So if we did nothing else and refurbed the properties and sold them at the market values given to us by our agent, we'll make 302,500 in profit. And so now I'm going to share with you some of the things we did, which saved us quite a bit of tax. The property had asbestos in it. So we paid quite a bit of money to have that asbestos cleared out. And if that is an issue for one of your listeners, then you can claim something called land remediation relief. If you claim land remediation relief, you get 150% relief on the cost. And this is for things like asbestos, Japanese knotweed, and other forms of contamination. So that saved us £14,250 in tax. What we then did, and I've already kind of shared the example in terms of incorporation, after we'd obtained planning permission on the site, we then incorporated that property into a limited company. So as you can imagine and appreciate, we bought it for £500,000, obtained planning for 6 one-bedroom flats and 6 two-bedroom flats. So when we incorporated, we had the property valued and it was worth £650,000. So because we've incorporated, we were now going to see an uplift in the base cost from £500,000 to £650,000. So that £150,000 additional base cost, that's going to save us 19% incorporation tax. And that 19% of 150,000 equates to £28,500 in tax savings. We did that because we bought a commercial property. We were able to claim capital allowances. So capital allowances are fixtures and fittings which are in a building. So I'm looking around in my office right now just to kind of give people a few examples. So we've got an aircon unit here. You can claim capital allowances for that. We've got a suspended ceiling. There's capital allowances on that. We've got smoke alarms, fire detector, camera system, the central heating and the radiator. So there's quite a few things here and a few of the bits in terms of comms. And on all these things here, you can claim capital allowances amongst many others. So we claimed £100,000 worth of capital allowances. In terms of physical hard cash in our pocket type of tax saving on that £126,000, we're going to save £23,964 in tax savings. Above and beyond that, what we also did was that property had VAT on it, and we bought it as a going concern. So we did a deal with the landlord for them to stay in the building for a certain period. And because they stayed in the building, not only were we buying the property, but we were buying we were buying a property business as a going concern. So we were able to not pay the VAT, which meant we paid less stamp duty. So if you buy a building for £500,000, Chris, and you've got to pay VAT on it at 20%, that means you're paying £600,000 for the building. You've got to pay VAT on, you've got to pay stamp duty on the £100,000 VAT element too. So you're paying VAT, and on top of VAT, you're paying SDLT. But because we did a transfer of going concern, we didn't have to pay the VAT. Therefore, we paid less stamp duty. So we saved £7,500 on that. And that wasn't just for the stamp duty. If we had to pay the £100,000 VAT, we'd have had to go to a bank or a third-party lender, said, can you loan the money to us for a period of 4 to 6 months? We'd have had to pay them interest, arrangement fees, all of that. So including all that, that adds up to £7,500. There's 2 or 3 other things we did, which aren't kind of necessarily all tax savings, but I'll share them anyway, because I think they will add value to your listeners. After having bought the building, because we were going through the planning process, we had to pay business rates. So what we did was work with a local charity, a social enterprise, and we said, we'll gift you use of the building. So you have the building for free as long as you carry on doing good for the community. So this particular charity works with homeless people. And that's something that is quite close to my heart, because obviously homelessness is on the increase in the UK, as it is obviously in Peterborough. And I'm a local city councillor, so I kind of see the detrimental impact homelessness has on families. So because this particular charity was helping homeless people, I said you can have the building for free and use it for an entire year rent free. They took that. The only kind of condition, if I can call it a condition, was they pay the business rates. Now, because they're a charity, they don't have to pay business rates. Mm-hmm. So they were able to save the business rates, and they were also able to get the additional 20% discretionary rate relief. So they didn't have to pay the business rates, and I didn't have to pay the business rates. And that saved us an additional $10,600. Had we not given the property to them, we'd have had to pay those business rates every single month. So that was a saving. And the final one is that because we're converting the building from a commercial property into a residential property, when we refurb the property, which was going to cost us £400,000, which you'll recall from one of the many numbers I shared earlier, on that £400,000, we have to pay 5% VAT. So that equates to £20,000. If we sell the individual units, we can claim back the 5%. If you don't sell the individual units, then you can't claim back the 5%. However, if you set up a wholly owned subsidiary, for example, and grant a lease of longer than 21 years to that subsidiary, so and then the subsidiary then becomes the managing agent, and then the lease is longer than 21 years, the main company, i.e. the company that owns the property, can claim back the VAT. So in this particular instance, we are going to claim back the VAT of £20,000. So all of those savings that I've just kind of quickly rattled through add up to £112,314. Now, if you recall, Chris, the initial gross profit was £302,500. If we add the additional £112,314, that's a 37.12% uplift. So we're going to make an additional 37% on top of the original gross profit. So in total, it gives us about 415,000 pounds in profit. So I hope that kind of demonstrates good, effective tax planning.
It certainly does. It certainly does. And I managed to keep up the numbers. That is quite impressive. Yeah.
Good. That's not because I made it easy for you. That's because you're pretty smart and you were kind of able to stay on top of it.
No, that's great. And did you say you had a second example as well, Shaz?
Well, I've got plenty of other examples, but I think that there's a couple of things that I'll run you through first, and then I'll share a couple of other examples in terms of some of the things we've done for property investors, which they found pretty useful. Now, if somebody has a spare bedroom, what they can do is rent that room out to a lodger or a tenant, okay? And as long as they give them use of their kitchen and their living room too, which one would do, obviously, because of that tenant would need to cook food somewhere and use their bathroom facilities, you can get an additional £7,500 tax-free under what's called rent a room relief.
Mm-hmm.
So that's tax-free. Obviously, if there's two of you who own that property, if you're husband and wife, then you get half of that each. You get £3,750 each. Now, here's where the interesting thing comes in. A lot of people are interested in running serviced accommodation, but they sometimes don't know where to start, or they're not keen to buy a property, or they're not keen to do something called rent to SA. So what they could do is, as long as they have a spare room, they could run their first serviced accommodation unit from that particular bedroom, earn £7,500 or up to £7,500 and not pay any tax on it. And then obviously if service accommodation works for them and they get used to systems, processes, how the whole thing works and think, this is pretty good, we like this business, they can then go out and obviously create a much bigger service accommodation business. So that's something people should look out for. If a property investor or any business owner's income is going to go over £50,000, they just need to bear in mind they are going to lose entitlement to child benefit. That's something people sometimes miss out on, and that they should consider. Something else which I would advocate is investing in ISAs, because obviously there's huge tax benefits for doing so. If you have children, try and use up their junior ISA allowance as well. That's pretty useful and pretty handy. And of course, if you've got other income from another business or other employment income, then do think about investing into a pension, because obviously there's tax relief on that. But I won't cover that because I know you've probably covered that in a previous podcast, and you guys do that so much better than I do, because I'm just a simple bean counter and a number cruncher.
Far from that.
Yeah.
Okay, well that's fantastic, Shaz, and I know there's a lot more that we can cover. One thing though, which is really important to the whole Wealth Builders values and principles, and I know certainly very important to our members, is the legacy aspect of wealth building. So I'd like to ask you, Shaz, and what is the best way for people to leave their properties for their children?
The answer is it depends, okay? But more often than not, creating a trust and then making the children beneficiaries, okay, is a good avenue to explore. So people should look at that very seriously, and that is a good strategy in terms of mitigating inheritance tax, and their children get to keep all of their properties. Of course, it depends on the size of the property portfolio and the value and how much they've got outstanding in terms of mortgages and what else is going on. But in terms of a very simple answer is start looking at trusts, because they are a good mechanism for leaving property to the next generation.
Brilliant, thank you. So is there anything that I haven't asked you today, Shaz, around tax, around exemptions and allowances that you feel it's worth adding in?
We could spend all day here, Chris, because I have a 2-day property tax course where I cover a lot in terms of the things property investors need to bear in mind. But I'll share a couple of quick examples for you on stamp duty, land tax, which I'm sure and I hope your listeners will find useful and beneficial. So if somebody is buying a property and that property has a granny annex on it, and that granny annex has a separate entrance and has its own kitchen and bedroom, then the buyer can reduce the amount of stamp duty they pay. Let me run you through a very quick example. So if somebody is paying £500,000 for a property, they'll have to pay a certain amount of stamp duty. I don't remember the exact number. Let's just kind of make it up and say the stamp duty on that's going to be £30,000. In reality, the figure is not £30,000, but let's just say it is £30,000. If that property has a granny annex with a separate entrance and it's got its own bathroom, kitchen, facilities, what they can then do is they can claim something called multiple dwellings relief. What that means is you divide, okay, the total cost by 2. So in essence, you're paying £250,000 for each property. In reality, you're not, obviously, because the granny annex is not worth £250,000. But because they're classed as 2 separate dwellings, okay, you can claim multiple dwellings relief, and you're paying $250 for each dwelling. What that means is you're going to significantly reduce your stamp duty. So if we use the example that it would be £30,000, which in reality it wouldn't, but if it would be, using that example, that purchaser would probably save £10,000, okay, by claiming multiple dwellings relief. So that's something people should look out for. Something else which people should look out for is if they are buying a property which is uninhabitable, then they don't have to pay the additional 3% stamp duty for a second property. So if they already own their own home and they're buying a second property, there's the additional 3% stamp duty that a purchaser has to buy. But if the property is uninhabitable, you don't have to buy that 3%. And you probably won't be surprised to hear that quite often people approach us where they've bought a property which is uninhabitable, clearly uninhabitable, but they've missed out and they've ended up paying the 3%. And I also get quite a few clients now, mainly through referrals, where they are buying a property with a granny annex, usually it's their own home, but because they own other properties and they don't intend to sell the main home where they're living right now because they're going to rent it out, they end up paying a lot of stamp duty because they haven't, or additional stamp duty because they haven't claimed multiple dwellings relief. So that's something to look out for. So those two things are quite handy in terms of cash flow.
I think that's great, and I think that we should cap it there because, as you say, Shaz, there's a number of stuff that we could go on. But thanks so much. So Shaz from AA Accountants, appreciate your time today. Thank you for sharing on Wealth Talk, and I'm sure that you have given a huge amount of value for our listeners today.
Thank you very much for having me, Chris. It's been an absolute pleasure.
Okay, so Kevin, what did you make of all of the insights there from Shaz?
Well, I've got ache in my wrist just noting all those things down. But you see, one of the things you'll notice is, isn't it just great how people are enthusiastic about what they do? You know, I just love that about Shaz. And I will pick up on something though that he mentioned that I can't remember exactly how many tax changes, but 37 or something tax changes and more to come, and that's always the way. And the big one, of course, which has hit everybody in the world of property, is this thing is often referred to in curious tax language as Section 24. And you will have heard him mention that and probably go into some detail about that. But essentially, the government made a decision to tax landlords, and while there was a big effort with crowdfunding to try and stop that, if you remember, Sherry Blair was kind of forefront of that. And it just didn't get defended, and as a result, the government brought in this notional Section 24, which essentially it kind of says previously your mortgage was classed as an expense. So if you had an income of £1,000 in a property and the mortgage was £200, your tax bill would be on the 800. And all they've done is said, look, that's not happening anymore. And over a number of years, that's a sliding scale down to getting, some of it allowed, and then little less and a little less and a little less. It's easy to Google Section 24. But essentially, you're going to pay more tax if you're a landlord, which is why it's really important to understand corporate structures, and talk to people who know what they're doing about whether you should own your property in your own names, whether you should own it in an LLP or limited liability partnership, whether you should own it in a limited company. And there is no obvious right or wrong answer here. You just have to take good guidance. And remember also, going back to previous podcasts, Chris, we talked to our contributors who were much more focused on commercial type property, where they're not affected by Section 24. So you've got to really think through exactly what you're going to do from a strategy, from a structure, from allowances. So tax needs to be front and center when you're working on property for sure, but in every pillar really, because there are always reliefs, exemptions, things that you won't know unless you're in the know. And that's why being connected and being part of our community will always try and bring you those nuggets of knowledge to help you not just create your wealth and build your wealth, but protect it as well. Not just for now, but for the next generation as well.
That's right. And of course, everything we teach with regards to the wealth building structure, with the foundation, with the 7 pillars and the roof, an important part of that is being able to leave a legacy behind for your family, your children, loved ones. And I asked Shaz about the best way of how to leave properties to your children. And Shaz's response was obviously the use of trusts. And again, we've talked about this. We've done a specific episode in the past, haven't we, about trusts, Kevin?
Yeah, I mean, anybody who knows me knows my reason why was fueled by, the very early and tragic death of my dad. And as a result of that, everything in my life has been focused on almost acknowledging, in my own mind, probably, a big focus on the legacy and trying to protect my 3 kids and my wife. And that's important to me. So I think it's one of the most common things I hear people talk about, particularly when we talk about pensions as well, which has got a very different tax treatment. People talk about their final salary pensions and sometimes the loss of that legacy. I think legacy is starting to become more and more of an important topic, Chris, and so much so that recently when I was at a SSAS Alliance event and it was a whole subject of the evening, I want to really bring a podcast just to talk about legacy and how to start thinking about that, not in a negative way, just contemplating and considering your own demise, but to think about it as a positive way. I mean, if anybody cares to check, enshrined in our value set, the values that I created when I started WealthBuilders, one of those values was to build your wealth and leave an incredible legacy, but along with the wisdom which it's taken to accumulate it. Because so many countries have words for the way that the next generation and the next generation will dissipate the wealth that was created by the original entrepreneurs. And there's some countries call it shirt sleeves to shirt sleeves and 3 generations, others clogs to clogs. But the principle is the same, so the transference of knowledge, the transference of wisdom, as well as the transference of money is really an important thing. So I thought we'd do a little kind of just take a breather from property and maybe do an interlude on that before we start getting ready for my most exciting asset that I love more than any, which is the business pillar. That demands a whole different set of skills, and look forward to diving into that in due course. But why don't we do that legacy one next time?
Yeah, I think that would be great. Okay. Well, thanks for your time today, Kevin. I've enjoyed it as always, and I'm sure we'll catch up on the next episode of Wealth Talk.
I look forward to that, Chris, and until then.
See ya.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the WealthBuilders membership site to help you create, build, and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.